Today we'll start the second module. We know as part of portfolio management, we have to carry out security analysis. In order to analyze the security, there are different approaches such as fundamental analysis, technical analysis, and efficient market hypothesis. So this module deals with fundamental analysis. The fundamental analysis is also known as EIC analysis, which stands for Economy, Industry and Company Analysis. That is, the fundamental analysts will take into consideration various factors regarding the economy, industry and company to calculate an intrinsic value for the security. They will compare this intrinsic value with the market price in order to arrive at a buy or sell decision. So what is fundamental analysis? The fundamental analysis takes into consideration the factors relating to the company, the factors that are important in the industry in which the company is part of, and also we'll take into consideration the various economic factors. Now there are analysts who will first consider the economy, then consider the industry, and then come to the company analysis. And this is known as the top-down approach. Now some analysts will do it in the opposite direction. That is, they will take into consideration the company factors first, then they will analyze the industry, and then take into consideration the economic factors. This approach is known as bottom-up approach. So there are two approaches of fundamental analysis. There is top-down approach and there is also bottom-up approach. Now, we'll see what are the various factors which are considered under the economic analysis. As part of economy analysis, the investor has to consider all these factors. The first one that needs to be considered is the growth rate of the national income. So in order to identify the rate of growth in the national income, we'll turn to the GDP, GNP and NNP estimates. These are all published annually or frequently. So these factors can be considered before making an investment decision. So to identify the national income, we'll see the GDP rate. If it's showing a good increase or a consistent increase, then it means that the economy is stable and it is good for investment. So the first factor that needs to be considered is the national income. The business cycle should also be taken into consideration. We know there are 4 phases in the business cycle. There is a depression stage where the business is performing very badly. The economy is in a very bad condition. So there is a depression stage. Then there is a recovery stage in which the conditions slightly improve. Then there is a boom phase where there is a lot of prosperity and the business is performing really well. And there is a recession stage where it is again declining. So we have to take into consideration the stage or the phase of the business cycle before making an investment decision. The second one is inflation. So inflation can be measured using the wholesale price index, the consumer price index, producer price index. These are all helpful for analyzing the level of inflation in the economy. Now, what is the wholesale price index? Wholesale price index is a basket of representative wholesale prices, and the changes in these prices reflected in this index. It shows the change in price of commodities which is exchanged between corporations. So wholesale price index can be taken into consideration. Now a country like India depends upon consumer price index to study the inflation rate. Now consumer price index is a basket of commodities which is purchased by consumers for household purposes. This is a more dependable index than the wholesale price index. So we rely on the CPI to study the inflation rate of the country. Now countries like America depend upon producers price index. There are various ways in which you can study the level of inflation in the country. Now during the time of high inflation, the companies will be performing a little low, so it's best not to invest during those times. The next one is interest rates. The interest rates means if you are borrowing funds, if funds are available at cheap rate, then the business will be more willing to take loans, invest in the business, use it for expansion, modernization, diversification, then they will perform better. When they expand, they will be producing more, and when they produce more, their cost of production comes down. When the cost of production comes down, they can offer quality products at reasonable rates to the consumers. So the interest rates needs to be considered. If there is high interest rates being charged by the financial institutions, then the industry or the economy is not going to attract much investors. But if interest rates are cheap, then we can attract more investors and the companies will be performing better. The fourth one is government revenue, expenditure, and deficit. We need to consider the various sources of revenue of the government. That is, they will collect it from taxes. The government will get funds from foreign countries by taking foreign loans. They can collect funds by issuing bonds to the general public or through treasury bills. So they will collect the revenue for the expenditure. Now, the source of expenditure is they will use it for construction of dams, roads, infrastructure. So we'll take into consideration the expenditure during a particular year and the revenue of the government during a particular year. Now, suppose the expenditure is more than the revenue. Then in that case, we are facing a budget deficit. So the time when the budget is issued, we'll be able to know how much is the budget deficit. If there is high level of budget deficit, it means the expenditure is more than revenue and therefore the economy is not performing that well. Then the next one is exchange rates need to be taken into consideration. So if there is frequent fluctuation in the exchange rates, then it's going to affect the export industry and the import industry. When the import is more than the exports, it means we are spending more than we are earning. If the import is more than the exports, then that situation is known as balance of trade deficit. So there will be a trade deficit if there is more import and export. Now we'll compare all the activities. There is a trade, the services, capital transactions and all will be compared. And if that is more than the income, then we'll say that it is a balance of payment deficit. Now we'll also take into consideration the foreign exchange reserves. If the country has got good foreign exchanges, then our economy is a little more strong and we can rely on the business to be performed really well. But if foreign exchange reserves go down, then the country is not performing that well. Now, if we have got trade deficit or balance deficits, then the government is going to settle these deficits by taking from the foreign exchange reserves. This will reduce the reserves and will indirectly affect the performance of industries. So exchange rates need to be considered, and if the exchange rates are stable, then it's okay to invest. The next one is infrastructure. If the country has got a good infrastructure, it is offering good road and railway connectivity, it has got good telecommunication facilities, then the companies will be able to perform better. So if the country has got a good infrastructure, there is a possibility for an industrial growth. Next one is monsoon. Agrarian economy. Ours is an agrarian economy. So we depend upon agriculture to get the raw materials for production. For the agricultural sector to perform well, there should be monsoon at the right time and in a sufficient quantity. If we do not get monsoons, then the agricultural industry will be affected, which in turn will affect the production because raw materials will not be available and the companies will not be performing that well. So the monsoon needs to be taken into consideration. The last one is economy and political stability. If the political conditions is not stable, then it will also affect the economy. If one political party is succeeded by a different political party, then there will be change in the policies and the preference given to various type of industries, and it might adversely affect the performance of the industry. So these are the factors which needs to be considered under the economy analysis. Now we have to forecast the changes that might come in the future. An investor will be interested in knowing the future dividends that he will earn as well as the future change in prices. So to do that, we'll carry out economic forecasting. Now there are various techniques for carrying out economic forecasting. The first one is anticipatory survey. Anticipatory survey will be carried out by taking into consideration the intention of people in the government, business, trade, and industry. That is, they will carry out a survey among the consumers, asking them their chances of purchasing durable goods and non-durable goods in the near future. Then they will carry out a survey among the government to identify their plans in the future. How much are they going to spend in a particular for the development of a particular sector. They will also take into consideration the plans of the business, trade, and industry by carrying out a survey asking their plans for expansion, modernization, and diversification. By taking into consideration their intentions, we can arrive at a decision of whether it will improve in the future or not. But these anticipatory surveys are not that reliable because people might not always do what they plan to do. They might deviate from the plan. So these type of surveys are not that reliable. The second type for economic forecasting is barometric or indicator approach. Under the barometric or indicator approach, certain indicators are studied closely to take out clues on whether there will be a change in the economic conditions. So these indicators are of three types. There is a leading indicator, there is a coincidental indicator, and there are lagging indicators. Leading indicators means these indicators will change ahead of economic changes. When there is a change in these indicators, it is an indication that the economic condition is also going to change. When these indicators fall, it means the economy will soon follow suit. If these indicators perform in a good way, then it means the economy will also improve in the near future. So these are very useful for those who are analyzing the economic conditions. The second one is coincidental indicators. These indicators will move along with the economy. That is, it will change at the same time that the economic condition changes. Now, lagging indicators come only after the economy has changed, and these are not very useful for us for forecasting. So the leading indicators are what is relied upon or depended upon by the people who study the economic changes. The fourth method is econometric model building. Under econometric model building, the mathematical and statistical techniques are used to study the relation between a dependent and independent variable. So if a certain variable is changing, then what are the factors that led to its change? These are studied and these are represented using mathematical formulas and statistical tools. So this is known as the econometric model building. These are techniques used under economic forecasting. There's also one more technique which is known as opportunistic model building, or it is called other names such as GNP model building and sectoral analysis. Under the GNP model building, sectoral analysis, or opportunistic model building, two GNPs will be calculated. That is gross national products. Two rates of GNP will be calculated. The first one will be estimated by taking into consideration various factors such as the total demand in the economy. And then the second method is calculated using the various factors which are considered in calculation of GNP, such as the consumption expenditure, the private domestic investment, government purchase of goods and services, net exports. These are considered, and the second GNP is calculated. The first GNP is calculated using tax rates, interest rate, rate of inflation, economic and fiscal policies of the government is used to calculate the first GNP. Then these two are compared, and then they are tried to make, the analysts will try to equal both these values together, and then the economic forecast is done. So these are the various methods for economic forecasting. With that, we come to an end of the economic analysis. The second stage is industry analysis. So the firms which produce similar kind of products are grouped under one particular industry. So industry analysis takes into consideration the factors which affect the industry as a whole. That is, the firms which produce similar products are grouped under one industry. For example, like pharmaceutical industry, textile industry, cement industry, steel industry, etc. And we'll study the factors which affect a particular industry as a whole. So the industry's life cycle needs to be taken into consideration as part of industry analysis. There are 4 stages for industry's life cycle. The first one is the pioneering stage. This is the stage where the firms have just introduced a product and they have not yet perfected their technology. So there's a great scope for growth and there's an opportunity for earning profit. During this stage, a lot of firms are coming into that particular sector and there's going to be a competition and the weak firms will be eliminated and only those strong firms can survive the pioneering stage. Now, it is difficult for an analyst to identify those companies that will survive or those companies that will come out strongly later on. So it is best to wait till the company has proved itself before making an investment in this type of industries. The industry is also known as sunrise industries. The industries in the pioneering stage are called sunrise industries. So investment in this stage is highly risky, so it's best for an investor to wait it out. The second stage is expansion stage. Once the industry has established itself and it has overcome the initial competitions, it has entered the second stage, which is the expansion stage or the growth stage. So in this stage, the company continues to become stronger. That is, the company will find market for its own. It will start developing new markets and it will develop strategies to sell and maintain its position in the market. Since the condition of the companies has improved, they can offer the price at a lower price during this stage. During this stage, it is quite attractive for investment purposes because there will be high returns at low risk. During this stage, the demand exceeds the supply because only a few companies are there, those companies which have survived the initial competition, and there will be more demand than supply, therefore they will be able to earn high profits and thereby the investors can also enjoy high returns at low risk. So it is advisable to invest during this stage. The third one is stagnation stage. In this stage, the industry has expanded as far as it can and now it is slowing down and the profits are slowly going down. There will be change in the social habits, new technologies might have come up, therefore the company or the industry is not able to perform as it used to perform. So the ones who are holding securities at this stage needs to start looking for other options. They need to take out their funds while the company is still profitable and then invest in some other avenues because the last stage is going to follow up, that is the decay stage. During this decay stage, the technology has become obsolete or outdated. New technologies have replaced the technology. The product has got no longer demand. It has become out of fashion. So during this stage, the company will not be able to give any profit to the investors and it is best not to stick along till the company reaches the decay stage. It's best to sell the securities during the stagnation stage and avoid the loss that will follow during the decay stage. So the life cycle of the industry needs to be taken into consideration. There are 4 stages. Now the other factors, the industry characteristics needs to be considered as part of the industry analysis. The first characteristic is demand and supply gap. We know that if there is less supply and there is going to be huge demand, the huge demand will push up the prices and the companies will enjoy more profits which will be shared with the investors. The investors will also be able to share a percentage of the increased profits in the form of regular returns. Now, if the supply is more than the demand, then the price is going to fall and the profits enjoyed will go down. So we need to consider whether the industry in which we are planning to invest has got a excess supply or a excess demand, and then decide whether to invest or not. It's advisable to invest in those industries which has got less supply and more demand. Next one is competitive conditions in the industry. So we have to take into consideration the various competitive forces. That is, whether there's a barrier for new entrants in the industry, whether that particular industry is facing a threat of substitution, whether the industry has given it the industry has a bargaining power of the buyers is more, or if the bargaining power of the supplier is more, or if we have got too much rivalry in the form of competitors. See, if the bargaining power of consumers is more, then they will resist when there is an increased price, and the company will not be able to overcome that barrier. In the same way, if the supplier's bargaining power is more, then they will have to pay more for the raw materials, and thereby the cost of production cannot be reduced. Therefore, we have to consider the competitive conditions in which the industry is performing. Now, there are certain industries which enjoy benefits such as product differentiation, absolute cost advantage, and economy of scale. See, product differentiation means this product is differentiated from other competitors' products. That is, the people have a loyalty, customer loyalty towards that product. They will opt that company's product even if there are competitors. Thus, that company will perform better. So, if we have to see whether that company enjoys product differentiation, if so, it's safe to invest in that type of industries. We have to see whether they enjoy absolute cost advantage. That is, established firms, those which have been performing consistently over a period of years, they can afford to offer their products at a reasonable rate. They can even afford to reduce the prices than their competitors. So they enjoy absolute cost advantage, and these companies are also reliable for investment, can be relied upon for investment. Next is economy of scale. See, if it's a good company, it has expanded, it has established itself, they can engage in large scale production. When there is large scale production, the cost of production goes down, and therefore they can offer the products at a reasonable rate. So if it's a company that enjoys economy of scale, then they can attract more consumers by offering products at reasonable rate, which will lead to increased levels of profit. So if they're getting higher profits, then we can also benefit by getting regular returns. The investors or the people who have purchased those shares can enjoy regular returns. So it's good to invest in those type of companies. Now, the next third characteristic that needs to be considered is the permanence. In a particular industry, how long has this company been performing? How long has it been consistently earning profits without any losses? Those which have survived longer are more reliable. Next is the labor conditions need to be taken into consideration. If there are too much strikes and rebellion going on, then it's best not to invest in that particular industry, because production might be interrupted without any warning, and it will affect the performance of that particular company. So the labor conditions need to be taken into consideration. The next is the attitude of the government. The government will sometimes promote certain industries, and sometimes the government is against certain industries. They choose to discourage the industries through their various policies, and through by asking them to take license and increasing the tax rates. So the attitude of the government needs to be taken into consideration. If the government favors the industry, then it is good, because the company will not be facing unforeseen obstacles in the future. The next one is supply of raw materials. We need to see whether the industry gets a continuous source of supply of raw materials. See, if the raw materials are imported raw materials, or if it is a very expensive raw material, then the company cannot afford to continue production in times of depression, or in times when the company is not performing that well. So we need to see the supply of the raw materials. If the raw materials are domestically available at cheap rates, then the company has got more promise of performing better. we have to also take into consideration the cost structure as part of the industry analysis. See, there are two types of cost. There is fixed cost as well as variable cost. The variable cost varies according to your production level, but the fixed cost remains same throughout. Whether you earn profit or not, you will have to pay off the fixed cost. So if the element of fixed cost is more in that particular industry's cost structure, then their break-even point is not going to be achieved that easily. Break-even point is the point where there is no profit and no loss. So even if the company is performing really badly, if they get break-even point, then it's good because they can continue with the running of that industry without shutting it down. But if the fixed cost element is more, then it is difficult to achieve a good break-even point, and a margin of safety will also be very low. Lower break-even point provides higher margin of safety. So choose an industry which has got lower break-even point, lower fixed cost element in their cost structure, and your investment will be more safe. These are the factors which need to be considered under industry analysis. Next is company analysis. In order to analyze the performance of a company, we can depend upon financial indicators as well as non-financial indicators. Now, the financial indicators consist of financial statements and the ratio analysis. Financial statements need to be correct, complete, consistent, and comparable. In order to ensure the correctness and the completeness of the financial statements, companies can get their financial statements audited by external auditors. And they need to follow the same methods of calculation of depreciation as well as inventory management in order to ensure the consistency in the books. Only if the books are correct, complete, and consistent can we compare the statements with those of other companies as well as the performance of the company with those of the previous years. So to facilitate interfirm comparison as well as intra-firm comparison, the statements need to be correct, complete, and consistent. The financial statements are mainly of two types: the income statement, which is also known as profit and loss account, as well as a position statement, which is also known as the balance sheet. Now, while we are analyzing the income statement, we need to consider the certain elements such as earnings from regular operations needs to be taken into consideration. Maybe because of some special circumstances, the company was able to earn extraordinary gain in a particular year. Because of some unexpected change of events, they had to face extraordinary or abnormal loss during a particular year, maybe because of natural calamities or something like that. So while we are analyzing the income statement, we have to make sure that we keep these extraordinary items aside. Okay, we cannot consider that the company is performing well because of some extraordinary gain, or we cannot say that the company is a bad one by just taking into consideration the extraordinary loss. So extraordinary gains and extraordinary losses should be mentioned separately in the statement, and we have to analyze the company after keeping those factors aside. We also have to take into consideration the inventory method which is being adopted. Is it following the LIFO method or is it following the FIFO method? Because the method of inventory that you choose will reflect the level of profit in the books. So which method of inventory is being recorded in the books needs to be taken into consideration before arriving at a particular decision. So during times of increase in price, LIFO method will show a reduced profit in the books. So we have to take into consideration the inventory method which is being adopted by the company before arriving at a investment decision. The third one is depreciation. There are different methods for calculating the depreciation. If they are following the written down method value, then their initial depreciation is going to be high, and over the years depreciation level is going to come down. And when the depreciation amount goes down, the tax that you have to pay increases. And therefore, when you're paying more taxes, it will automatically reduce the profit that the company has. So the depreciation, whether it is a straight line method or the written down method which is being adopted by the company, needs to be taken into consideration. Now the earnings per share, what is the earnings that the investor is going to get for each share that they hold should also be considered before making an investment decision. So while we are analyzing the income statement or the profit and loss account, these factors need to be considered. Second one is position statement or the balance sheet. When we are analyzing the balance sheet also, we have to consider what is the taxes which is being paid and what are the dividends which has been paid over the years, what is the depreciation method which is being calculated, what is the value of the assets, what are the outstanding loans and leases and other financial arrangement, what's the capitalization structure. All these needs to be considered before we make an investment decision by looking into the balance sheet. Now we can also study the statement of changes in financial position. What is the change in the financial position over the years? This can be also considered. Now, another method or another financial indicator is the ratio analysis. The ratio analysis can be carried out as cross-sectional analysis or time series analysis. If we are comparing the ratios with those of other companies, then it is cross-sectional analysis. Whereas if we are comparing it with the past data of our own company, then it is known as time series analysis. Now, ratio analysis, there are different types of ratios such as liquidity ratio, leverage ratio, profitability ratio, activity or efficiency ratio. So all these types of ratios will help you to study the financial position or the financial performance of the company. So these needs to be taken into consideration as part of company analysis. Now, what are the non-financial indicators? There are certain non-financial indicators also. First one is the business of the company that needs to be considered. The investor needs to see what are the type of products which is being offered by the company. If it is a consumer non-durable good, then it has got continuous demand. Whereas in case of durable goods, people might postpone the purchase of that product till there is a prosperity or till the economic conditions are good. But in case of non-durable goods, there is a continuous demand, and that companies have a promise of performing better. So it's good to invest in that type of companies. Then we need to consider the management. Who is in charge of that company? Are they efficient? Are they experienced? Are they honest, and have they got a vision for expansion and growth? These factors need to be considered. The third one is market share of the company. How much of the market is the company holding? Has it got a large share? If it has a large share, it has got better prospects of controlling the market and will earn more profit margins. Now, what is the product range? They can introduce new products and thereby overcome competition. So we should see whether it has got only a single product or it offers a product range. The next one is diversification. If the company has diversified into various sectors, then it can face risk more easily, and there is less chance of loss, because even if one particular sector is not performing well, the profits from the other sectors will sustain that company. So whether that is a company which engages in diversification, whether they have modernization and expansion policies, what is the distribution policy? They should have a stable and consistent distribution policy in order to earn good profit margins. Now, they should distribution means they should distribute their profits as dividends, bonuses, etc. So, how much of their profit are they going to distribute among the investors? That needs to be considered. Now, foreign collaborations, do they have fundings from foreign companies? Then what is the availability of inputs? Are raw materials easily available? Or is it expensive, or it does it have to be imported? Then what's the research and development which is being put into to upgrade the existing product? Do they introduce new products through their research and development? Do they have import substitutions? And this needs to be studied. Then the government policy should be taken into consideration, whether it is subject to price and distribution control, or do they have any particular restrictions or regulations. Next one is purchase time. The purchase time needs to be decided. If you are interested in purchasing the securities of a well-performing company, then it is best to time your purchase when the securities are going through a bearish phase. During the bearish phase, the prices are going down, so you can purchase a security at a low price for long term investment, and during the long term the price will go up again. Now, new millennium trends need to be analyzed. Is it a see, some industries have just started performing well, and these industries have got a good growth prospect, and these industries need to be picked out, such as artificial intelligence, biotech, high-tech industries, e-commerce, multimedia, so robotics. So these are all new trends, and these are performing well. They're picking up pace, so these can be safely chosen as part of our investment. So that was with regard to the fundamental analysis. There was economy analysis, industry analysis, and company analysis. Now, the Michael Porter model emphasized that the profit potential of a company depends on the combined strength of the following five basic competitive forces. So these five competitive forces need to be considered in order to identify the profit potential for a company. So let's see what are the 5 points. The first one is threat of new entrants. See, if a company has already entered into a particular industry, now how far do they have to face competition? Will new entrants pose a competition for that existing company? That needs to be studied. See, if it has got a entry barrier, then the existing company will not face much competition, because suppose sometimes the government may interfere by asking them to take a license or to register and get permission of the government prior to starting that particular company. Now, if the licensing is a very tough process, or if it involves payment of a lot of amount, then people are going to be discouraged and new entrants will not come into that particular sector. Then the existing company can perform really well. Now, sometimes that existing firm may be one that is enjoying economies of scale. They have already expanded and they are producing at a large scale. So, even if new competition comes, they'll be able to reduce their cost of production and thereby offer their products at a lesser amount than those of their competitors. So, these companies have a chance of surviving competition even if new entrants come. Now, if they have got a sufficient amount of capital, then to start the company, if that is required, then not everyone can afford to come into that particular industry. Then again, competition's threat will be less. So these factors need to be considered. What is the product differentiation? Do people have a customer loyalty towards that particular company's products? If so, then even if competitors come, people will not switch over to the competitors. They will continue purchasing products of this particular company. So the threat of new entrants need to be taken into consideration. Now, once that has been overcome, the second one is rivalry among the existing firms. Under rivalry among existing firms, we need to take into consideration the number of competitors that the particular company is going to face. Now, what is the growth of the industry? If there is a slow rate of growth of that particular industry, then the rival firms are going to compete for a higher market share. But if there is high rate of growth, there will be less rivalry since the market becomes large enough to absorb all the firms. The market keeps on expanding. So even if new people, if the existing company keeps on expanding, everyone has got market for their products. But if there is only limited market, then there is going to be tough rivalry when they try to capture more and more of the market. Now, the level of fixed cost, if the fixed cost is more, then the intensity of the rivalry is going to increase, because they will have to earn sufficiently in order to meet the fixed cost and then earn some profit. Now, the exit barrier, suppose the cost of shutting down that firm is too much, then the companies will do everything possible to survive the competition. So the rivalry will increase if the exit barrier is high. Now, what is the capacity of the industry? That is also taken into consideration. If there is overcapacity, that is everyone has got a potential for high production, then there's going to be very tough competition among the competitors. The third one is pressure from substitute products. Under this, we need to consider what is the price of the substitute product. What is the switching cost? Switching cost means the cost of switching from our product to their product. If the switching cost is less, then there is going to be higher threat for that particular company because people will switch to the other product or the substitute product effortlessly. When what is the customer propensity? What's the mindset of the customer? Do they have a brand loyalty to a particular company? If not, then they are going to opt to the substitute product. Then the profitability level of the industry. If the company that is introducing the substitute product has got superior profits, or if it's a very strong firm, then this firm will not be able to survive the competition. So that is the pressure from substitute products. The fourth one is the bargaining power of the buyers. If the buyers has got a good bargaining power, then they will resist any change of price rise, and the company will not be able to survive in case they need to raise the price. So what is the concentration of buyers in a particular region? What is the volume that they purchase? What is the level of information that the buyers have? What is their buying habits? Do they have substitute products? What is the difference in the product quality? All these need to be considered as part of bargaining power of the buyers. And the price sensitivity should also be considered. The brand loyalty is also an important factor under bargaining power of the buyers. The fifth one is bargaining power of the sellers. If the suppliers exert pressure on the companies as they increase the price or lower the quality, that will also affect their performance. So suppliers have a strong bargaining power in the following situations. When the switching cost of the buyers are high, that is, we cannot, if we need to choose another supplier, then it's going to cost some more, then we'll be reluctant to leave the supplier and move to another person. Then if the switching cost is high, then the supplier has got a strong bargaining power. And the suppliers are, if they are located in a particular area, concentrated in a particular location, then all of them will equally increase the price. Then we do not have an option to switch to anyone else. When we do not have any substitutes for that particular product, if we do not buy from this particular supplier, we do not have any other substitute for our raw materials, then also the threat is high. So these are the 5 forces which determine the profit potential of a particular company. This is Meyer-Porter's model. So this is the main contents of the second module. Thank you.